All right, we seem to follow a normal pattern here of getting some positive vaccine news or COVID news over the weekend, starting Monday morning really strongly. Unlike previous Mondays where we kind of held those gains and maybe even built upon them a little bit, today not so much. In fact, we couldn't hold any of our gains today on the S&P 500, and that kind of shows us, kind of gives us a lot, especially considering how extreme the bullish sentiment is. It appears that that extreme bullish sentiment's not carrying through to performance anymore, especially after these weak, strong overnight gains with very weak amounts of volume, of course, driving them. Once the volume kicks in, we see what happens. So we're going to talk about that, how that impacts or relates to our expectations, not just in the short term for the markets, but also how these extreme sentiment indicators impact our long-term expectations, how those two things jive together, and then what we're seeing in terms of sector rotation and asset class performance today that might also provide some clues as to what the market's doing here in the short term. So let's go ahead and get started. Today is Monday, December the 14th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 with the market forecast indicator. As you can see, we have a bearish day today after starting up and going up throughout the day relatively well early. Then we came down and closed at the low of the day. Obviously, a lot more important where we close than where we open. Again, we've talked about a million times before about common gaps that close, and we've also in our market scholars trading rooms, we talked about this idea that any vaccine news is well baked into the cake. If you look at the long-term linear regression for the S&P 500, let's say go over 10 years, then you can see. Look at the trend line. Here's your best fit trend line. There's COVID. So we are, if this is the pace over the last 10 years, then COVID hasn't dented that, briefly dented the pace. But by last June, we were back to pace, and then of course we've been above it ever since. So this idea that the vaccine will help us recover has already been priced in. You can see we're already back. Well, in fact, we're back to the top end of the first standard deviation channel. So vaccine news is not going to push us higher, at least in the long term. Maybe in the short term, from a knee-jerk reaction standpoint, from an algorithm standpoint. But as you can see, it doesn't last very long, as it lasted pretty much all night in the early morning session. But then once volume came in, then we sold that news off because the market's already priced the vaccine in. The market's already pretty much priced COVID out, as you saw on that linear regression chart. The posture is still strongly bullish and market sentiment is still rising. So you still got a good long-term trend despite the little bit of selling. And we are still just between 0 and 23. And I've told you before, anytime we trade between 0 and 23, it's just noise. Up or down, it's just noise. So we are coming down. We do have short-term sentiment, but it's not dropping. And this is technically a bullish intermediate confirmation signal. So based on this pattern here, we'd expect that we'd bounce tomorrow. All right, the momentum line would bounce out of here, especially because it's only barely below 20. The near-term line will bounce back above 50, and then it's a matter of whether we'll get new highs, which you would expect that we would, because this little near-term, here's the, if I were to draw Fibonacci retracements on the near-term run that we've been on, so coming from this low point all the way up to this high, we're basically sitting on the 38% retracement level of the near-term pullback. So you expect a good bounce off of it. Otherwise, we're going to start to make our way through the Fibonacci retracement zone on the near-term basis, and then to this 23% line. And then there's the question of whether or not we will start to break that. If we break that, then we're on an intermediate pullback. The intermediate line will probably turn down below 80, and we'll move on from there. Here is the Dow Jones, looks very similar. The NASDAQ 100 also looks very similar, except its short-term sentiment has jumped up above 50. And then the Russell 2000, where its near-term line has just barely dropped below 50. So we haven't had a near-term pullback, and this is kind of the first little bout of weakness. And even then, we are still up at 0.1% with a little bit of a long upper shadow. So not very much weakness here at all on the Russell. Remember, the Russell's been on an intermediate run for longer than the S&P has been. The S&P just barely started. We're a month into it. the Russell 2000 is 2 months into it with a little brief pause there, but not enough of a pause to be an actual intermediate decline. So we've had a pretty decent intermediate run up to this point. And now it's a question of how long we're able to sustain it, considering we didn't get very much of an exhale here, or very much of a pullback previously prior to this little intermediate run. So, and of course, when you're looking at the long-term view, and we still got, obviously multiple days left before this long-term view is over, but you can see the short-term sentiment and what kind of pattern it's starting to develop heading into a new week, and then there's your intermediate run, and how far above the 30-week moving average we are right now. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback. If you like our videos, we'd love to hear from you. You can do it with one click. You can let us know with one click. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch if you don't like them. Also, comment on our videos. What did you get out of them today? What questions or comments do you have? Post those down in the comment section below. Join our website at marketscholars.com. There's a link popping out right there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle here at DavidSettle42. And then join our Market Outlook Facebook group that we've created. If you're watching us on YouTube, I invite you to check out some of these other things on our site, including our Market Outlook live videos where I review all the old trades that we've done and other Market Outlook videos. So every day I do a Market Outlook. I also do a live video at 3:30 Eastern Time. Click on this link. You can get to today's video as well as all the other archives. 3:30 Eastern Time, we produce it live, so that's where you come to watch it live. These are all of our trading rooms that we have upcoming. Remember, all of our Plus and our Premium subscribers get access to our trading rooms. Our Premium subscribers get access to other things in addition, including our Q&A sessions, all of our class forums, as well as premium resources and tools that we have. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also, click on the thumbs up icon here. Also opens up another new tab with today's Market Outlook Facebook post. Click on that like. Again, the more you do that, the more our content will get seen by more of our followers because of the more engagements and likes it has. It also benefits you when you do that because Twitter and Facebook will promote content from your timelines, in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, let's get back to the charts here. Let's take a look at the 3 green arrow chart, and you can see that we now have 2 red arrows, and with that stochastics crossing the 75th percentile. If you take a look at the 2-line versions, you can see the stochastics has already crossed below the 80th, and it was well below its moving average. MACD, the histogram is increasing. We're still holding the 17-day moving average, so we haven't really broken that yet. That's when you really start to see signs of an intermediate pullback when you break the 17-day. That's not there yet, so we're not too concerned. We're still, we are down below 60, so we're not bullish, but we're not below 50 yet. That's when you start to again worry about an extended intermediate pullback. We're not below 0 on the CCI, definitely not below negative 100. That's also when you start to worry about a intermediate pullback. The DMI, it's still, the ADX is still above 20, though it's falling. The negative index is trying to break down below 20. The positive index has broken back up above 31. So there are some positive signs from that perspective. If you look at the Ichimoku cloud, we still have a moderately strong trend. We're still above 3. We're still above 75. We're still flirting with the green line, well above the cloud. The red line's above the price, or green line's above the blue. I mean, we're still on a bullish trend. We're just showing some signs of weakness today, and we're getting a little bit of an exhale. So there's nothing wrong with that necessarily at all. As you can see, we're still above the value area on the 1-year chart, so it's still very bullish. We're not in the upper quintile, the upper quartile anymore, the bandwidth, but we are at least in the upper half. We haven't broken into the lower half yet, where again, It's where you start to get concerned with, an intermediate pullback when you get down there and then you stay down there. So again, that's not an issue at all. All right, now let's take a look at the intraday chart, and this is where, again, people were excited this morning about the upward gap, but remember, common gaps get filled, and that wasn't, that's not a breakaway gap. We're not breaking through any significant resistance. It's not a runaway gap. We're not coming off an intermediate low point. It's a common gap. It was a bigger common gap, but if you look at it on this chart here, you can see, where is it? This one. You can see down here at the bottom, not a very significant gap. When you put it in perspective, not a significant gap at all. And you still got a really wide gap between implied volatility and historical volatility down there. So a normal gap, whether it gets filled in on an intraday basis or whether it takes another day or two or maybe even a week, remains to be seen. But obviously we filled it in immediately and came down all throughout the day and closing at the lows. A little bit up in the after hours, but remember, we don't want a gap up in the after hours. You prefer the gap down in the after hours because then you can fill in the gap going up throughout the day instead of going down throughout the day. We're breaking back below the point of control, breaking back into a volume gap in the last 4 weeks. This low point here of the last 4 weeks is sitting, will be here for about another week, right, before we start to, and really about a week and a half. It might move up a little bit once we get this day off. But about another week and a half before we start to ramp it up to this really high level at 360. And then, we're only looking at about 11-point range. Now we're starting to get a really tight range. Even as it is here, you're looking at about a 17-point range, which is getting pretty darn close to 50% or 5%. That's again, normally a pretty wide stretch, but we've been so stretched out a lot further than that. So you can see how it's really tightening up. As we slow down here. We were so slow for so long. Here, let me go to a little bit longer time frame. We were so slow for so long, and then we ramped up a little bit, but we're still been kind of sideways since the election. Since the Pfizer news, we've been really kind of flat with that small breakout to another level higher here and unable to really continue and get going to the upside. Whoops, wrong chart here. Let me take a look at this chart's got the volume that we look at. So the volume hit average right about 70 million. The trading range was above average because obviously we filled in the gap. So when you look at this chart here, then you can see 70 million shares trading. That's above average here, or right about at the average. But that's we're really pretty low as it is, and we're not breaking that 1% mark on the ATR. So, if we're really going to be bullish, then we need to bounce off of here and start getting trading ranges of about 3.5 points or lower, not 5 points, and start getting that ATR down, itself down below 3.5 points or 3.75 points as the price moves up to the upside. That's when okay, we are trending higher. We obviously would also need to break below 20 here, and we're not. We're actually ramping up and get stay in this bullish territory. And we started the day back down bullish territory, but worked our way back into the neutral zone. So we'll see if we work our way up through this. Again, my expectations are that we still need an intermediate pullback, especially considering that we've had a month-long intermediate run. I do not expect this one to be nearly as long because we had such a long one and we didn't exhale. So now with a very shallow exhale, after a big deep inhale, a shallow exhale, now I expect another shallow inhale because it's hard to take make another deep impulse move without a pause, right? Without more of a deeper exhale. And deeper exhale on a relative basis, like more than likely coming down towards the 78th percentile there. So to summarize our technical outlook before we look at what's driving the price action today, obviously we've been bullish. We've been on this bullish run, this bullish intermediate run. We never really got, a good exhale to where we could start a good multi-month intermediate run. And we've been on one for now about a month, two, if you count the Russell 2000, which has been stronger. Which has been in catch-up mode and appears to have now caught up to at least the S&P and the Dow. Obviously not the NASDAQ, which is way up far ahead of everybody this year. But it has caught up to like the S&P. So, and it has been strongly bullish. We've talked about ad nauseum all the extreme sentiment indicators out there that on one hand suggests we can be really bullish going into the new year and for 2021, even into 2022. On the other hand, in the very short term, it doesn't mean we have to drop. It just limits any kind of upside we get, as we saw today, a good strong opening gap, and we were filled it in by the end of the day. So it's going to be harder to stretch the gains to a larger extent, to a good strong momentum extent, without more of an exhale that we can build a better base and then bounce off of and really get going again for multiple months, similar to what we had here earlier this summer. So what do you think? Do you agree with that assessment? Do you disagree? Comment down below as to why. Why, especially if you disagree. Why do you disagree? What charts or indicators are you looking at that suggests that either you're a lot more bullish than I am or you're a lot more bearish than I am? And again, my expectations are I am expecting more of this, a shorter intermediate run than what we've had, because we never did get a stronger intermediate pullback. With the extreme sentiment indicators, I am very bullish in my long-term portfolio, but in the shorter term, I am expecting in a more neutral, not climbing aboard the bullish train, but also not really shorting this heavy either, just maintaining both bullish and bearish deltas right now, with different time frames, of course, to be able to take advantage of what we've got, but not overload myself. So let me know what you think about that. All right, well, let's take a look at what's driving the market action here, the price action today. And you can see we started off really strong. REITs were higher, small cap stocks, QQQ, SPY, all U.S. equities with the vaccine news, right? The vaccine rollout started off very strong. Oil, commodity prices did okay to begin the session. High yield bonds outperforming treasuries down here in yellow. By the end of the day, treasuries came off their lows. Gold came down, dollar was flat. Emerging markets and developed markets were really weak. So they have been doing very, very well. In fact, if you look at the 3-month, if I go back to just the 3-month return, 3-month returns, those areas had been doing really well, and they're starting to give a little bit back. Small caps haven't started to give back some, but you can see what they have to give back, right? So their margin of safety is poorer from a 3-month return standpoint to give some of this back. And then of course your safe haven areas are really kind of down, have underperformed over the last 3 months. You can see long-term bonds, if I were to go out a little bit longer term on this Fibonacci retracement, so that's the bullish rally in bonds that we've had. You can go all the way up. This is the COVID high point that we had there on March the 9th. We've now kind of come down. We've had dark pink shading in the red line throughout this period. The difference now is, market sentiment's obviously very low, but the difference is now that this low point on the intermediate line is not in the reversal zone. So we've had, kind of this bearish run, and now we're in light green shading in a yellow line. We'll see what this turns out into and see if we get. I think this is the kind of move that we can expect to see coming up into this next bout of this intermediate pullback that we have on equities. That's bonds. This is gold. Gold has also been in this dark pink shading red line pattern as we pull back down here. In fact, if I were to make this, activate this and draw this all the way up to its high point here, so let me activate that again. Activate that and draw this all the way up to the top. So we're just flirting with that 23% retracement level after actually having come down to the 38%, close to the 38% with these clusters. Now starting to bounce up, very strong bullish near-term run. The intermediate lines rolled over as we got light green shading and yellow line, we're kind of bouncing down. The question is whether or not we'll get some kind of inverted head and shoulders pattern here and get a higher low point. That's what the near-term line is suggesting so far. And then finally, the dollar, when you look at the dollar as compared to the euro, you can see we got the cluster here, good strong run. We got the cluster. Again, it's like, very, very strong moves in these safe haven areas. This would obviously be a bearish move for the dollar. So very strong moves for the safe havens. They've been lagging behind, as you saw on the 3-month chart. They've all been lagging behind. If equities were to have any kind of pullback, as you can see, they're kind of rolling over a little bit momentum-wise, and we see that, in the 2-line versions of this. When you look at SPY, we've already seen that. IWM, not so much. It's still easily above the 8-day moving average, and the Qs bounce back above their 8-day moving average, even if their MACD and stochastics are rolling over. EEM is the one that's closest to flirting with breaking the 17-day, and EFA, you can see its MACD and stochastics are really rolling over and picking up some momentum to the downside. So it's kind of suggesting that there's more weakness here to come. If we take a look at the foreign markets, that kind of gives us an idea of the breadth of the bullish risk appetite. Where is it? Here. Again, this is listed by the biggest economies in the world, and you can see the rollover that we're getting. Quite a few, like the EU, Germany. You can see how we're still pretty far away from the moving averages in some of these. Korea's rolling over. Russia's giving us Canada's rolling over. Russia's giving us an engulfing pattern. China has broken its moving average. You got dark pink shading now. It's got a 41. Everything else is like in the 90s in the intermediate line. This is still a 41. So it's really lagging behind. But again, you can see the kind of weakness, the kind of little bit of a rollover occurring all throughout the world in all these different equity markets. Now let's take a look at how the sectors, let's start off with the 12 grid here on the sectors first. Of course, our cyclical sectors here at the top showing the most strength, but look at the rollover in energy and materials and industrials and financials. Those are some pretty bearish candles across the board in these areas that have been so strong. Utilities and real estate obviously rolling over. Healthcare and staples not looking too hot. So you can see the weakness across the board when I look at just how they performed here today. So we'll go to the 3-month chart, but then we're going to go to just today alone. So right here, and we'll go to the 14th. Energy obviously dropping off. They had been the big winners, as you saw previously. They're dropping off the most. Technology, discretionary, outperforming, as you would expect that they would. You remember here's the ratio chart of large caps to large cap tech stocks, QQQ to IWM, and you can see it's starting to roll back up, right? So we've had this outperformance in small caps. It got below the 200-day moving average. We got to where we have a negative PPO here because the 50 days crossing below the 200. But you notice the histogram is bottomed out, and which is the gap between these two lines, and it's starting to kind of roll over and roll up a little bit. So losing that negative momentum and slowing down, we'll see, if it bounces back up, which I expect that it will, and we avoid, significantly getting below 40 and making a run back above 50, then we're looking for another bullish run, which means in any kind of bearish moves, these things will outperform. And we saw that before, if you recall, back in June. So when we peaked in June here, not 21, when we peaked in June to the end of June, I believe it was the 26th. So where did we peaked up here on the 8th, so starting on the 9th. So once we started to roll over, then you notice this large cap stocks, technology, communication services, consumer discretionary held up better, and we saw that today, right? So when you look at just today's move here to today to just today, and actually it'd be 14th and the 14th. You can see that again, that's your financials, your materials, your industrials, your energy stocks all fell the most, and everything dropped, but technology and discretionary held up better. So that's why the S&P didn't drop a lot. These two held up better. But when you look at, again, just going back to the other chart, the asset class comparison chart from the beginning of the day. Here, let's go to here. to just today alone, small cap stocks were up the most at one point in time. We're up over 1.33%, and the S&P was up just under 1. The S&P finished down 0.5%. IWM finished down about 1/4%. So the IWM had a pretty decent move from top to bottom, while Qs actually held up and outperformed. And again, that's what we'd expect would happen. So if we do continue to get weakness, specifically in these cyclical areas, expect that these large cap areas will hold up until they kind of roll over. Again, just like what happened in June. All right, when I take a look at our trade idea of the day, I want to take a look at one of those large cap tech names, and we're going to take a look at Netflix, which you can see is just turning into some dark green shading and green line after having kind of trading between the 0 and 38% level multiple times of this bullish rally that we had. Some dark pink shading and red lines, and now finally breaking back above the 23%, closing above quite a few weeks worth of highs here today. If you take a look at the 3 green arrow chart for Netflix, and you can see a little bit of a bounce up in volume with 3 green arrows today. The stochastic's giving us the 3rd green arrow today. This is what that looks like on a 2-line version here. You can see the MACD turning back up, the price getting back above the 8-day moving average, the stochastic starting to turn back up, potentially getting back above its moving average here pretty soon. The RSI and the CCI are showing bullish patterns, getting above 60, getting back above 100 without getting below 0 there. Look at the directional movement index for Netflix, and you can see bullish patterns there, almost getting back above 30 on the positive. That's the highest we've been so far on this little bit of a rally, so starting to break out a little bit. And if you look at the Ichimoku cloud, we broke through the cloud and getting back above the top of the cloud. The price, red line getting back above the price, starting to work our way after a really noisy period here, maybe working our way towards the trend, getting above the cloud. So, and when you look at the Bollinger Bands here, you can see kind of bouncing back above this volume node that we were forming at that point of control, right at the 38% Fibonacci retracement, and bouncing up. So you can see I got a blue line there, which means I got one break even on the chart. And what I've done is we've done a bull put spread where my short strike price, my break even, was right at the point of control. So if it holds for support, we're fine. So I sold the 490, bought the 485, and we ended up getting about $1.25 out of it. I believe we position size for a full position, getting about 30+% return on risk on that trade. And again, you can see there's my break even sitting right at that point of control. Here's where the break even is on the intraday. The point of control on the daily chart's right here at 488, and that would be below all these lows. So basically, if we're going to get down to that level, we would nullify this breakout and then today's breakout, which got us above, multiple weeks worth of highs with today's move. You can see, getting above all of these highs here finally, and working our way towards the top of the 90-day value area and potentially punching through. So a good, safe, bullish trade for a January expiration that gives us a high probability of a decent return for that risk. And remember, even though I'm position size around $1,100, we're only going to be willing to take $375 out of that because that's what we're shooting to make. All right, so you've heard from me now. Now I want to hear from you. Let's use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's threads. And let's keep this conversation going about the market posture and what's driving things and what we can expect and what we'll do about it. Post those all in the forum and interact with others of our Market Scholars community at the same time. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Give us a thumbs up on the channel as well as on Twitter and Facebook. Give us a like. We really appreciate that. And then comment on our video. Have a great rest of your Monday night, everybody, and we'll see you all next time.